Welcome to the Tech2day podcast powered by CEORater. It's your host, John Maeda. Check us out online at CEORater.com. Anonymously rate your company, rate your CEO. Visit us at Tech2day.com for the latest in technology-related news and content. Last week, we published our initial CEORater CEO Risk Report. That's a premium report from us, whereby we called out a number of CEOs for corporate governance-related issues. In each instance, we pointed to SEC documentation if there was an ongoing or a recent SEC investigation. In addition to the source documentation, we provided our expert opinion as to what we believe the implications are from those investigations and what that means for corporate governance risk for each company. More recently, this week, we've published content at Tech2day, which is primarily focused on the Federal Reserve and what we believe the implications are for Fed policy, monetary policy, and rising Treasury yields. And the Fed came out earlier this week, as we said they would, and it said they're going to hold pat on their extremely dovish policy, hold rates where they are. And as we've said, we believe the next move out of the Fed will be yield curve control, not rising interest rates. We believe the Fed wants the economy to run hot, that inflation is the Fed's friend. Reason being that as we have inflation, tax receipts increase, and the fiscal side can use those ballooning tax receipts to pay down the mountain of debt that it's created through the two Trump stimulus plans and now the $1.9 trillion Biden stimulus plan. So we don't believe that where we have record debt levels, the Fed is going to raise interest rates in the face of those record debt levels. So look for yield curve control. The fact that high multiple technology stocks are starting to pull back, I don't believe that's going to be enough to get the Fed to exercise yield curve control, some sort of a cap on the 10-year, for example. I believe what you'll see is that if we start to see the broader indices roll back, that could be the catalyst for the Fed to take action as it relates to capping rates. The other thing we wrote about, and what I think you'll start to see in M&A pipelines, is you'll see M&A activity pull back. A week and a half ago, approximately, CoStar announced that it was walking away from its deal with CoreLogic, and they cited higher interest rates. And I think you'll see more of that with respect to deals that are in the pipeline. You know, in some cases, companies may walk away from the deals altogether. In other cases, companies may look to get creative in terms of the financing structure. But as the 10-year continues to climb, cost of capital is a real issue now as it relates to M&A activity, particularly in the tech sector where valuations have pulled back and companies don't have quite the equity currency that they had, 4 to 6 weeks ago. And so where equity valuations aren't quite as rich and debt's going to be a larger component of deals, and now you have the interest rate on debt going up, that's going to slow some deals. So that will slow both deals in process to the extent that those are larger deals for a particular company. And then it will also have an impact on the landscape, because obviously rising interest rates create an issue at the corporate level as it relates to balance sheet resources. And so rising yields is going to have a net slowing effect on M&A activity in general, but in particular in the tech sector, especially where equity valuations have begun to roll back. But stay tuned for more. That's all for now. See you next time.